Welcome to the presentation. Today we will be discussing FASB ASU 2016-02 on leases, or topic 842. If you're watching this webinar today, you've probably been hearing about the new lease standard for a couple of years now, and it is finally here. So this presentation will focus on providing an overview of the standard, what changes you should expect, and will hopefully guide you through the process as you're implementing the new standard. I just want to start off by giving a brief introduction. My name is Dan Krol. I'm an audit partner with Bowers & Company CPAs. Bowers is a local CPA firm with offices in Watertown and Syracuse, New York, offering our clients a wide range of financial services in the areas of accounting, auditing, taxation, business valuations, financial planning services, audit examination, and consulting. It is my pleasure to provide you with another reminder of the new lease standard today. And as always, our team at Bowers is available to answer any questions that you may have related to new standards or any of the services that we offer. Just a brief outline of what we're going to cover today. We'll start off by looking at the old lease rules. We'll look at why the changes in the lease standard and lease accounting. We'll go over the new lease rules under ASU 2016-02. We'll look at how the transition is going to happen and some of the elections that you need to make along the way. We'll look at the presentation, how it's going to affect the balance sheet. We'll discuss some of the lease implementation challenges. We've been going through this process now with our first quarter compilations, some of our 2022 audits that have been going on right now. We've already been implementing this new standard. And then finally, we'll leave off with the lease calculations and kind of discuss some of the software that we use here at Bowers, what we have and what we use that can be assistance to you as well. So the old lease standard that you're probably familiar with, if the lease meets any of the following four criteria, it should be classified as a capital lease. If the lease transfers ownership of the equipment to the lessee by the end of the lease term, if the lease contains a bargain purchase option, if the lease term is equal to 75% or more of the estimated economic life of the leased property, or if the present value at the beginning of the lease term of the minimum lease payments is equal to or exceeds 90% of the excess of the fair value of the leased property. If any of these are met, it'd be a capital lease. Also under the lease rules, there's a capital lease, as we just mentioned, will be calculated as the present value of the minimum lease payments using the lessee's incremental borrowing rate, calculated to determine an asset value and a debt value, effectively placing the lease on the balance sheet. Under the old standard, operating leases, monthly lease payments were expensed as incurred. So capital leases, there's going to be very little change, as you'll see, going into this new standard. Calculation is going to be pretty similar, still going to be on the balance sheet. You're just going to see a change in the name from capital lease to finance lease. Operating leases, there will be a significant change. Instead of having monthly lease payments that are expensed, you will also have an asset and a liability on the balance sheet, which would be similar to the capital leases that you've seen in the past. So why are we going through this change in lease accounting? Well, back in 2016, February of 2016, FASB came out with ASU 2016-02 on leases, which, as you can believe, is over 5 years ago now, and we're finally getting through this implementation process. For public companies, they were required to implement this back in 2019. And for private companies, 2022, this is the year of implementation. So why did they choose to do this? First of all, to increase transparency and comparability among organizations by recognizing the lease asset and lease liability on the balance sheet and disclosing key information about leasing arrangements. And second, previous lease accounting was criticized for failing to meet the needs of the users of the financial statements because it did not require lessees to recognize assets and liabilities arising from operating leases. So, few key points here. The old lease standards, capital leases were on the balance sheet, operating leases were not, and the rules segregating the two were not very transparent. So they wanted to improve that by having some consistency and requiring all leases to be on the balance sheet to make it easier for the users of the financial statements to understand. So under the new lease rules, as I mentioned, FASB ASU 2016-02 is effective now. So you should be aware of the standard, going through the implementation process, and be ready for your 2022 year-end audits, compilations, etc. So FASB does provide a 5-step process that kind of walks you through the standard. So step 1, this would be to determine if you have a lease that qualifies under the new standard. You'll look at the following criteria. Is there an identified asset? Do you have the right to obtain economic benefit from the use of the asset? Can you decide how and for what purpose to use the asset? Do you have the right to operate the asset throughout the period? And did you specifically design the asset and the lessor has no other use for it? So all of these are criteria that are going to help you determine if you have a lease that qualifies under the standard, or maybe it doesn't qualify because one of these criteria are not met. To help you walk through this process, the AICPA has provided a flow chart to kind of help you answer these questions as you go along the way. As I mentioned, you start with, do you have an identified asset, the right to economic benefit, and the right to control the use of the asset? If all of these are in existence, then you have a lease. Just an example here, if you have a vehicle lease for, let's say, a 5-year term, you walk through the process here. Do you have an identified asset? Yes, you have the vehicle. Do you have the right to economic benefit from the vehicle? Yes. Do you have the right to control the asset, the vehicle? Yes. Then you have a lease. Some more difficult scenarios, let's say you have a lease for space to keep your inventory at a third-party warehouse, and the space is not specific, and the lessor can substitute that space as they feel throughout the lease term with different warehouses or different areas within the warehouse. Now, in this case, it may be difficult to have an identified asset because it's not specific to what space you're leasing. And it may be difficult to control the use. The lessor controls the use of that asset. Then in that case, most likely you do not have a lease that qualifies under this standard, just as an example. So very difficult depending on the type of lease that you have. So make sure you walk through this process and understand the definitions in each of these steps. So now that you've determined if you have a lease, the second step would be identifying the recognition criteria, very similar to what we saw in a capital lease. These are the criteria that would meet for a finance lease. Does the lease transfer ownership of the underlying asset to the lessee by the end of the lease term? Does the lease grant the lessee an option to purchase the underlying asset that the lessee is reasonably certain to exercise? Is the lease term for the major part of the remaining economic life of the underlying asset? Key point here, economic life may not be consistent with book life or GAAP life or tax life. So make sure you understand what economic life of an asset is versus maybe the tax life. Number 4 is the present value of the sum of the lease payments and any residual value guaranteed by the lessee that is not already reflected in the lease payments equal or exceed substantially all the fair value of the underlying asset. And then finally is the underlying asset of such a specialized nature that it is expected to have no alternative use to the lessor at the end of the lease term. If none of these criteria are met, then the lease should be classified as an operating lease as opposed to a finance lease. So once you've determined if you have an operating lease or a capital or a finance lease, The next step would be to calculate or measure the liability and the right of use asset. The lease liability is going to be equal to the present value of the lease payments, discounted using a discount rate of the lease. The right of use asset is going to equal the initial lease liability plus any lease payments to the lessor at or before the commencement date, plus any initial direct cost and less any lease incentives that were received. These calculations can be relatively simple when it comes to a vehicle lease or a simple office lease. However, they can get complicated when you have to incorporate variable lease payments, which you got to make sure you understand what is variable and why it's variable. Is there an index that creates variable lease payments, which may be different? So make sure you work with your auditors or your accountants to work through this process and understand all of these payments that are applicable. Step number 4, after we have the initial measurement, how is this going to be measured subsequently? Finance leases, you're going to amortize the right of use asset, and you're going to decrease the lease liability and record interest expense. On the operating leases, you're going to calculate a single lease cost, which is equal to the total lease payments, less incentives, plus the initial direct cost divided by the lease term. And this will be amortized expense on a straight line basis over the lease term. Now, when it comes to the transition of this new standard, there's 2 different approaches that you can take. So you want to make sure you make these decisions early so you know the effect on the balance sheet. The first approach, so if the optional transition method is not adopted, companies are required to recognize and measure the leases at the beginning of the earliest period presented in their financial statements. This is called the modified retrospective adoption. So for example, if you are a December 31st year end, this would be an adoption date of January 1st, 2021, if you have comparative statements. The second method tends to be probably the most popular method that we see in our client base right now is the optional transition method. This is to recognize the cumulative effect adjustment to opening balance of retained earnings in the period of adoption. So if you're December 31st year end, this would be January 1st, 2022. The reason this is more popular is it's easier to adopt in the current year instead of calculating the liability for last year, reviewing leases that were in existence last year, etc. Some reasons you may choose the modified retrospective approach. Maybe you want comparative financial statements, in which case you want the asset and liability to be on the balance sheet as of 2021 as well. You may choose this adoption even though it may be more work. Some other optional elections that you'll make going through the decision-making process here. Short-term leases, you can elect to not apply the standard to leases less than 12 months. So short-term leases you can expense as you have in the past on a month-to-month basis, not record an asset and liability. Non-lease components, you can elect to account for lease and non-lease components as a single combined lease component. This can make it simpler when it comes to breaking down lease components, when it becomes difficult to break down the payments between lease components, etc. Just a simpler approach. The discount rate, as we standard kind of mentions, you can use the implicit rate in the lease, you can use the incremental borrowing rate, or you can elect here to use the risk-free rate of return as the discount rate for all leases, regardless of the implicit rate. And this also can be done by asset class. So you can make a decision by asset class whether you use the implicit rate, incremental borrowing rate, or the risk-free rate. And the risk-free rate will be calculated by using such rate as like the treasury bill with a term consistent with the lease. The last election here is the transition reliefs. If you elect this, you're going to elect all of these together. You can't pick and choose which part of this you're going to elect. So if you elect these reliefs, you can elect not to assess whether expired or existing contracts are or contain leases, not to assess lease classification for any existing or expired leases, and whether initial direct costs would have qualified for capitalization for any existing leases. So this is important. If you have a lot of leases, this may be a good election to make, so you don't have to reassess whether your prior capital leases or operating leases were classified in accordance with the new standard. So now, how is this lease going to be presented? So a lessee shall either present in the statement of financial position or disclose in the notes of the financial statements all of the following: finance lease right-of-use assets and operating lease right-of-use assets separately from each other and from other assets. The finance lease liabilities and operating lease liabilities separately from each other and from other liabilities. The right-of-use assets and lease liabilities shall be subject to the same considerations as other non-financial assets and financial liabilities, and classifying them as current and non-current in the classified statements of financial position. So you will have a current portion of your lease liability as well as a long-term portion. And then finally, in the statement of financial position, a lessee is prohibited from presenting both the finance right-of-use asset and the operating right-of-use asset in the same line item, as well as the finance lease liability and the operating lease liability in the same line item. So you will want these separate on the balance sheet. So as I mentioned at the beginning of the presentation, we have been going through this implementation with our quarter one audits and compilations. And we have seen some challenges and some challenges that may not be bad, but you want to make sure that you understand what these challenges are going to be. So the first is the impact on debt covenants. Most of the banks are aware, if you have debt covenants, they're aware of this lease standard. However, it's still important to communicate to them what leases you may have and what the effect is going to be on the balance sheet, so that they can be prepared for how this will change the debt covenants. Because as I mentioned, you do have a lease liability, both long-term and current portion, which can have a significant effect on many of the debt covenants. The second here is lease documentation. There's a lot of documentation that's going to be required. All these decisions should be documented, not just my leases don't apply. You should document why your leases don't apply, or why they do apply, or why they're a finance lease versus an operating lease. So you should have documentation that tracks the current leases. You should have a way of managing this documentation, calculating the leases, and reporting necessary information. Third, making necessary changes to operation systems, processes, and internal controls, depending on the leases that you have. Some of this may be applicable. And then finally, discuss the impacts with the users and stakeholders of the financial statements. Give them plenty of notice before year end. Maybe implement the standard now so that the quarterly reporting is going to be consistent with the year-end audit. Just things to consider and think about. Make sure you know those effects well ahead of time. And last but not least, as you're going through these lease calculations, we didn't provide an example today. I think the most difficult part of this process is gathering the information for your leases and, determining what payments are going to need to be calculated in your lease liability. Once you have all the information together, there's a lot of software available to help you perform these lease calculations. And here at Bowers, we use Lease Crunch. This is an online lease software that allows us at Bowers and or the client to input lease information and generate monthly journal entries, amortization schedules, and footnote disclosures for the financial statements. So this is something that we use. It's available. Any of our clients can, we can assist any of our clients in the lease calculations. This is very user-friendly. Input the information that you need. The output is very easy to use and to create journal entries. So that concludes our presentation today on the new lease standard. I know there's a lot of information on the FASB standard that was not covered today. The ASU is 190 pages long. So as you can imagine, there's a lot more to the decision-making process. You're gonna wanna make sure you document this along the way, work with your accountants through the process. And as always, feel free, thank you for taking time to watch this presentation today. And if you need assistance, please reach out to myself. My email is provided here on the last slide, dkrol@bcpllc.com. Also, feel free to reach out to your accountants, make sure you're communicating with them. You understand the effects of the lease standard, and reach out to any of our amazing team of Bowers as well through our website here if you need assistance. So thanks again for watching this presentation today.